Hello, everybody. Today, talking about investing in cannabis, what you need to know to protect your wealth. Gosh, there's so much to talk about on this topic. I'll kind of look at some of the bullet points. But first and foremost, if I'm going to invest in cannabis, I'm going to be very careful, do my diligence, see what state I'm in. I'm going to study valuations closely, so a dispensary in Oklahoma is worth a lot less than a dispensary in Maryland. You need to see what the market is, what the competition is. If it's a free market and anyone can open a dispensary, for example, near my parents' house in Oklahoma, on 1 mile, on one side of 1 mile of one road, there I think there's 5 dispensaries. That's not a good market if you can just drive up and down. So I want to be careful on that. I also want to think whenever I'm investing in any kind of private startup, if you're an investor, you're probably stable, you own your house, you got a good income, you've got stocks and bonds, and now you're going to take part of your portfolio, invest in a startup venture. It's higher risk, so don't invest anything unless you can lose it. Do your diligence. Make sure that their pitch deck's complete. If you don't know what all should be included in a pitch deck, find out. We have a pitch deck checklist. Same on financial model. Make sure it's robust and it's not filled with errors, and it actually considers everything they need to run the business, and also that's not unrealistic. Does the financial model allow for what if scenarios? Yeah, I get it. You pitched to me that everything's going to be great and you're going to sell cannabis at high prices and you're going to sell everything you make. But what if production's less, or what if prices are down? Can you look at other scenarios and see what happens to your model? Those are concerns. In some industries, it's very common to not make money, net meaning net income, for years and years, especially cannabis with 280E tax. And so you can still make a lot of money. You can grow a dispensary or farm, grow the revenues, and sell it at a valuation on revenues. And if you're investing in cannabis, part of your bet, a sizable part, is you're betting on federal legalization. I think it's going to happen in the next 24 months, actually. But even back 4 or 5 years ago, this movement's sweeping the nation. 8 out of 10 Americans want it. It's going to happen. The HHS department, the government, the FDA agrees it should be on Schedule 3. So the public wants it, the states want it, the federal government wants it. It's going to happen. It is happening. It's happened in a big way. And so that's a big part of your bet. So if cannabis goes on Schedule 3 tomorrow or in 2 years, whenever that happens, the valuation of all these companies is going to double overnight or more. If Viridian, who is, analyst, investment banker out of New York, they track this. They think valuations are going to go up around 7x the day legalization happens. So that's a big part of the bet. You're betting just hang on, build your brand, run operations. If you have a little bit of net losses every year, that's okay. You're playing the long game. By the way, many startup niches have losses for years and years. High tech, medical, oil and gas. You can lose money for quite a long time. So what does that mean? You need capital, and you need access to more capital than you think. And by the way, you also need backup lines of credit and it may be hard to get loans or traditional capital. So you need your angel investors, your friends and family, to make sure there's backup plans. What happens if those in your model, if worst case scenarios happen in year 2 or 3, and all of a sudden you're losing a lot of money? Are you going to go? Plenty of companies will go under. You don't want that to be you if you're the investor. So I'm very, very conservative. I want to look at the worst case scenario. I always say, I hope for the best. I'm going to plan for the expected, and hopefully we can get reasonably close to what we actually expect on our revenues and expenses. But I'm going to prepare for the worst, because the worst, if you have a 5-year model, you're going to have a year that's way worse than you think. And if you don't prepare for the worst, it doesn't matter if your other 3 years are expected and are great. That worst year can put you out of business. So I'll be very, very careful about that as well. What else I can think? So be careful on that. A lot of founding teams are more focused on making money and lowering taxes, but you as an investor, you might be more concerned about protecting your assets. So on that side of things, at this point where we are today, and especially with what the C corp rates now, 21%, it's I think very high probability C corp rates are coming down this year with our completely Republican Congress. I think we're looking at 15% rates. And so, with all the other benefits of C Corp from raising capital, way better asset protection, also way better investor protection. If the IRS audits a C Corp, they can't come audit you as an investor. They can do that in an LLC or flow through. You also aren't going to get hit with K1s and have to worry about money for distributions to pay a tax bill. When you invest in a C Corp, just like if you buy Apple stock, no one comes to you on April 15th and says, hey, pay tax for Apple made a ton of money last year. You owe taxes. No, I just own some of the shares. So if C Corp goes down to 15%, it's a slam dunk to me. There isn't going to be cash for dividends, so we don't need to worry about double taxation. That's a non-thing. And so if I'm investing in a dispensary or farm, I'm like, let's go all in. Let's grow revenues. If there's more money and net income and cash flow, great. Let's buy it. Let's open another store. Let's grow the business. Let's grow. We don't want to do any dividends, so we don't have to worry about that tax. And then let's do an exit, and I'll just have a capital gain. And also on C Corp, I might have a 1202 excluded capital gain and might make even more millions on the back end. And so at this point, if you're an investor, you should be looking at a C Corp. I personally would not invest in any kind of safe deal, LLC, S Corp, whatever. I'm doing a C Corp. And try to protect on that side. The tax codes, I think most of you know this, in cannabis, 280E means entities get no deductions or credits, and so that means they pay way more tax. And so 280E applies to companies that traffic, or not even companies, trades or businesses that traffic in a illegal drug on Schedule 1 or 2. That includes LSD, heroin, peyote, cannabis. Fentanyl used to include hemp and CBD. Those are now off the schedules altogether. We're hoping cannabis moves there, or at least to Schedule 3. Then 280E goes away. And so the day 280E goes away again, it not only makes the valuation of your company go up 7x, it makes your tax bill drop substantially, meaning your cash flow goes up substantially. Good news for every single cannabis company in America, about 200,000 of them. And there will be many, many more coming the day that happens. We're going to have an absolute startup boom as well. And so I think it's still a good time to get in. People are still growing and investing. We're seeing people expanding all the time. I talked to a California company that owns several dispensaries. They're buying many more right now. Another owner I talked to in Maryland owns a dispensary and a farm. He's buying 3 dispensaries in New York. So people in the business are growing and expanding. There's plenty of companies going under as well, particularly the ones that don't have enough capital. So be very careful about that. As far as strategic entity structuring to shield assets and multi-entity approaches, you've got to be very, very careful on that. You cannot use entities to beat 280E. Now, if you want to do what's done in the non-cannabis world, for example, let's put the real estate in its own entity. So if my dispensary goes under, they can't come under after my real estate. I still own the real estate. That makes perfect sense. Maybe the equipment's in another entity. But people that set up 10 entities to house their dispensary because they're going to juggle around their expenses to beat 280, that doesn't work. Period. Go read Harborside case. Doesn't work. Don't do it. So I would use C Corp to shield your personal assets. And then, again, just making sure. Also, another thing, there's actually a report in CFO magazine last year that came out, and they polled a bunch of sophisticated investors and family offices and angel investors. And what was the number one thing they looked at to to invest money, the number one thing, they wanted to find a world-class CFO on the team. And so if you're an investor and you don't see a world-class CFO on the team that knows cannabis inside and out, you should run for the hills. If you need to find one, reach out to us. If you're an accountant or CPA that want to become an expert in cannabis, also reach out to us. We can point you in the right direction and train you so you will be an expert in this space. But every cannabis startup needs an absolute world-class CFO that knows this industry inside and out, knows the accounting, knows the software, knows the insurance, banking, compliance, licensing, accounting, tax, all of it. And can do a great job. It's my belief. I feel I've proven this out many times. I've been a CEO multiple times. I've co-founded $80 million companies back in 2006 with my boss that we did an exit around $100 million. And I've been CFO of many, many multi-million dollar companies. And I'm a believer in that poll that CFOs can add 10 to 20% of the value of the company at exit. So if you're looking to do a $100 million exit, just attribute $20 million to the CFO. And I've seen it go the other way, where companies actually have a sale in process. They go to sell their company at $50 million, and then the due diligence teams come in and they find an absolute wreck under the hood, and the accounting's bad, the tax is bad, and there's hidden liabilities and no controls, and they either walk away and the deal gets killed, or the buyer just says, "Look, I'm not paying $50 million. I'll give you $43 million, or I'm walking." And CEOs sometimes don't get it until exit, but that value is there. It's real. There's a reason. Go look at the S&P 500. Go to the Edgar website and pull down their filings and find out who's the second highest paid person at every one of those companies. The CFO. Why is that? Because Nike and IBM and Microsoft and Apple, they get it. The CFO is extremely valuable in helping to build and grow the business. There's plenty of you CEOs out there that don't get it. Great. Go build your company. You're going to get less at exit, and you're going to build slower along the way. CFOs add a ton of value along the way as well. So anyway, that's all I've got for today. If you're an investor, a lot to think about. And if you have any more questions, reach out to us at dopecfo.com.